We're going to show the 620 call that expires today. This is a monthly expiration, and it's 12/17 of 2011. We'd like to clearly show you that up here at the $6 handle, they marked these calls down yesterday going into today's monthly options expiration. However, there were great opportunities, but you have to know how to sell. You have to know how to sell into the move. And that means that when you are making that wholesale market, you're offering back out to the public and selling back to the public. And there was times they marked them down, and when they were marking this call down yesterday morning, that's when your put side of the trade, that's this put side over here, like this one, that's when that was working. Here, you have to know how to get in, and when the stock breaks out, then the calls go up in value, but you have to know how to limit out of that order. Otherwise, you end up getting that reversal on them, and you go nowhere. So they mark to market it down to this wholesale price. This morning, this very same call that will expire today is going to get marked up with this pre-market Google gap. It's very clear that you start from the low print. That was the wholesale market that we were making yesterday, and we have all the live entries with this that were for 12:15. Today's 12:16, 5:55 a.m. So we will take a look at what that dollar gap ratio is here, and we'll also monitor this 630 put dollar gap ratio down to wholesale based on, once again, when this is marked to market at the top of the value, this is going to be marked to market at its lowest value, and this will be the inflated opening bell of the cash market in 35 minutes. 5:55 a.m. Pacific Standard Time, 12/16, 2011. It's about getting the price action, bid and ask on both sides, buy that markdown, sell that rally. So you got to learn that once you do get your wholesale transaction, that as they go up and they hit resistance levels, here's that 620 call chart right here, you can see that your put side is going to be very important. Okay? And part of what we do here is by this deflated area, the gap open value is the first inflated area. Once you clear this area, this 250 area is going to be where I'm going to give a limit order out right now. Yes, you're gapping up. That's a huge gap, but that's still that lower end of that market. I'm going to mark up the call on an entry right above the $3 level. So I'm going to go with the closing print that I showed you that we had. Was the close is right down here on yesterday's print, and the close was $2.21 nonetheless. And I'm going to mark up the another entry level. I'm going to mark another entry level, mark to market at $2.80 bid, and I'm going to mark another level at those are going to be the bids on the opening bell. Okay, and that's because right now we're 33 minutes to the opening cash bell, and this can change significantly, MMTs. But once again, on the call option yesterday on 12:15, they walked these all the way down. The upside where they were being sold at was up here at $5, and we were in these trades yesterday. And then bam, the put side paid. And then they were short distance, but then the call sides had got down to its bottom based on the equity movement, dollar price movement, but nonetheless I marked them down. So we're going to take a look. Once again, in your apprenticeship, it's very important that you understand all the key elements of short-term deflated calls with gap open up dollar price movement. It's very important that you understand deflation areas and using gap open up price action sequences. So yesterday, as I said, I had people buying at the end of the closing bell because they were marked down. And you do have a gap because the stock is strong. Strong as all get out. And it's a monthly options expiration. On the other hand, I will tell people this 615 call really got marked down. Closing bell, 590. The high was 10, the low was 530, the last print was 560. They're going to really gap these up on the opening bell in 31 minutes on the opening bell. And buying these yesterday at the deflated bottom was the right thing to do. And that one there, that 615 call was brought to my attention. And you can see how they marked the call option down to this very deflated price, MMTs. Once again, it's pre-market, it's here, it's now, it's live. And look at here. Look at where they started marking it down on the 15th. You realize the call was up there toward that $10 handle, MMT, and they took all that premium out. Look at that. That's very clear. And once you get down here, MMT, there were wholesale bids and entries to be sold into rallies by buying the call, but then they marked it down. And look at the all-time markdown when they first started trading these. That's going to be right, well, the last good lows is down here. And these were marked down to the wholesale bid. Once again, 615 call is going to gap up. And we're going to be watching where the exuberance is on where some of these gaps are going to be in these calls. Right now at 6 o'clock a.m., market opens in 30 minutes. How to use deflated call options, the value of those with morning gaps and selling into cash resistance levels. So when you're buying them down here, as we were buying some yesterday, down at the bottoms, when on markdowns, now you have to learn how to exit on the opening bell, on the cash market, on a 615 call, and limit out on those 620 calls on that gap open sequence. Both contracts are here. So what I will tell people is 615, that when that makes the high, the 635 put here is going to make the low, and there will be a trade. And yes, 2 days they went. One day it went from 1250 to 1750, and then yesterday it went from 1250 on the low to 16 with the gap open. So there were, great trades on the 635 puts yesterday. Once again, you've been given a gift, pre-market action.